Hello friends, one of our viewer wanted us to review the portfolio and he has mentioned that it is his swing trading and investing portfolio. There are a lot of things which we will learn from this portfolio, and especially the new investors who have recently started their investing journey. There is a lot to learn from this portfolio in terms of the portfolio size, in terms of the quantities that you should be buying, in terms of the percentage amount that you should be investing in a company, what are the type of companies that you should be prioritizing in your portfolio, whether you should do trading and investing in the same portfolio or not, plus my views on all the companies. So initially I will just go through all the companies and give my view irrespective of the quantity or the invested amount, and in the end I will try to summarize and will touch base on all the key points and my opinion on the portfolio. So let's start. So the number of holding that he has is 17 and the total invested amount is 34,800 and the current value of the portfolio is 30,900, and currently the portfolio is down by around 11%, showing a loss of 3,800. First company is Bajaj Finance and it has recently been purchased. It's a very good company, NBFC, a market leader in its sector. You can definitely continue with this company. The only issue which I see here is that you may not be able to do buy on dips if it falls further, looking at the size of the portfolio. But that's fine. If you have invested now, stay invested for long term, and I'm sure you're going to add more capital to your portfolio. So as and when you have the money available, you can think of buying on dips in this company. Next company is BIRET, which is Brookfield India Real Estate Trust. Number of quantity is 1, total invested amount is 303, and currently it is 2% down. This is a newly listed company. It got listed recently in February 2021. We don't have much detail about its past performance. We only have details for the last 2 years, and there the profit numbers looks very impressive, but that could be due to the low base due to the COVID time. Construction and real estate sector has not been a sector which has provided consistent returns to its shareholder. So I personally avoid this sector, and this stock becomes more risky because it's a newly listed company. You don't have much background and history about this company. So if you want, you can avoid this stock. Next company is Coal India and number of quantity is 10. Invested amount is 2,500 and currently it is down by around 17%. Now let's discuss a little bit about Coal India, because a lot of retail investors like this company because of its dividend yield. And if you'll see the return of this company, in last 1 year it is showing a very good return of 34%, but if you look at the 5-year return, you will see that it is in minus 30%. If you look at maximum return, you can see that it has provided minus 40% return. So anyone who has invested in this company in 2010, even after 12 years, they have not recovered their money. So as an investor, your focus should be on the share price appreciation, on the capital gain, and less on the dividend. Because if for dividend you will invest in these type of company, then you may get the dividend on regular basis, but your overall invested capital amount will start reducing. In case you are able to find a good company whose share price is also increasing, whose business is also good, and who's providing good dividend as well, then you can stick to those company. But the first priority should be the capital gain, and on top of that, if a company is providing dividend and plus growing as well, then you stay with that company. Such examples are TCS, Infosys. These are good companies whose share price also increases and they also provide good dividend to its shareholders. And also the business of the company is declining. Why? Because the world is shifting towards the green energy. If I were you, I would have avoided this company. Next company is GNFC, which is Gujarat Narmada Valley Fertilizer. It belongs to the fertilizer sector. Number of quantity purchase is 5 at 585 rupees, and it is currently giving a upside of 2.7%. Now for this company, the profit has not been very consistent. Sometimes it has also posted loss. So there is a lot of fluctuation in the profit. And the same you'll see in the chart as well. In 1 year, you'll see that it has provided good returns of 28%, but you can see the ups and downs. So in maximum chart pattern, you can see that company was almost flat for a very long period of time. Then it went up, then again it dipped, and then after COVID it went up, and now again it is dipping. If we look at the nature of the company, you will see that this company easily falls by 50, 60 or even 70%. You can see here that it fell by around 75% earlier. If I'll go more behind, you'll see that it fell by around 50%. And in this period also, you'll see that it was down by around 40%. So the fluctuation in this company is very, very huge. This company can easily go down by 50, 60%. So if I were you, I would have avoided this company. I would have rather invested in a consistent company who is providing consistent profit and returns. And one such company in the agrochemical sector is PI Industries. You can do your study on that company if you want. Next company is IEX, and total number of shares are 16. And currently it is down by 13%. So this company share price also showed a lot of growth after the COVID rally, and now you'll see that it has come back to its normal chart pattern, and the company has now fallen back from its top levels by around 40-50%. In these type of company, you don't know how much time they will take to recover. I would have avoided this company. Next company is Genco. Number of shares are 16 and the current loss is around 50%. One good thing is that you have not invested too much amount in this company. There's a penny share with a market cap of only 4.7 crores. I would definitely avoid these type of company. This is the chart pattern of Genco, and you can see from the time it was listed, which was in 2001, it has provided just 20% returns. It is a very small company, can be easily manipulated by the operators, and you can see it has happened multiple times. You can see that share has went to 10 rupees level multiple times, and then it has fallen back to around 2 rupees, 3 rupees, and you will see the same thing happening here again. If I look at the business of the company, the business has no power at all. Try to avoid penny stocks because chances of making money in penny stocks is very, very less. Next company is Jubilant Pharma. Current quantity is 5. The amount invested is 2300, and it is currently down by around 24%. For this company also, the profit is fluctuating a lot, and the same fluctuation you will see in the share price as well. This company also falls 40-50% anytime. So if you are investing in this company, be ready for that kind of fluctuation. Next company is KPR Mill, and the current quantity is 5. Invested amount is 2500, and it is flat currently. This in my view is a okay company, a average company. If you want, you can continue with this company. Next company is Laurus Lab, and this is down by around 8% right now. This again is an okay company, average company, but I would prefer to go with market leader first, which in pharmaceutical is Divi's Labs, and then think of investing in any other company. Next company, Paytm. Quantity is just 1, and it is currently down by around 35%. So in my view, Paytm is a company which I will avoid because I do not invest in companies which do not generate profit. This is a loss-making company right now, so I would stay away from Paytm. Next company is Polyplex, and quantity is 1. It is down by around 18%. This is a good company in the packaging sector. If you want, you can continue to hold it, but it will require a lot of tracking. Next company is Sale with 20 quantities, and it is currently giving a positive return of 4%. In my view, I avoid steel sector, plus this is a PSU, so 2 negative flags for me. Now let me also show you the chart pattern. So this is the chart for Sale, and if I look at the maximum return, you will see a chart pattern of this going like this. So it's a company in the downtrend. Nobody knows if it is going to recover or if it is going to give you good returns in future as well. You should always avoid companies whose chart pattern is going from this direction to this. The easiest way to find good companies are whose chart pattern goes from bottom left to top right. In case if it is going in the opposite direction, then it should be a red flag for you. You should stay away from those companies if you are looking to make consistent return from your portfolio. Next company is Tata Power. The power sector has not given much return in the past, but this company is currently moving from the old power generation methods, which were coal, to green power generation method, which is solar, etc. So there is a change which is happening in this company, and if you believe in the EV narrative, then you can continue with this company, but you will have to hold it for long term to see the results. Next company is Tech Mahindra. Number of shares are 2. Invested amount is 2000. Currently down by around 3%. A good company in the IT sector, but my first preference would be to go with the leader. Next company is Wipro, again from the IT sector, currently down by around 32%. This also is from the IT sector, but it's a very slow company. It will give you a very slow return. So again, my first preference in this sector will be TCS, which is the market leader. Next company is Zensar, which again is from the IT sector, which is currently down by around 36%. Again, a okay company. First preference, but still should be the market leader. And last company is Zomato with 9 quantities, currently down by around 38%. This company also falls into the same criteria of Paytm. It is currently a loss-making company which got listed with very high valuation. I would not invest in these company until they start showing some profit growth and a clear business model. So now let's summarize. So in terms of portfolio size and number of companies, portfolio size we have seen it is 35k, which I'm sure is going to increase in future. But considering the current size of the portfolio, the number of companies that we have, which is around 17, it's certainly a overdose for the portfolio. It's too much to handle in this size of the portfolio. So in terms of the portfolio size, the first priority should be to keep increasing the portfolio size if we want to create wealth in the future, because share market gives return in percentage, guys. So it will give the same return to the portfolio which is of a size of 35k, or if it is a size of 35 lakh. So for example, if you are getting a return of 10% on 35k, it will be 3500. But if you are getting a 10% return on a 35 lakh portfolio, it will be 3.5 lakh. So this should be the priority for all the new investors, to increase your capital amount. And once your capital amount increases, then it becomes very easy to earn money from share market. And then the requirement for you also in terms of percentage will reduce. This is something which is very basic, and I'm sure most of the investors know about it and are going to prioritize this. But if this was not on your priority list, then you should make a note and start working towards it, that how you can increase your portfolio size. You can do it by either way, either developing your skills, which will give you better job so that you'll be able to earn more and save more and invest more, or start monitoring your expenses and try to reduce your expenses so that you can save more and invest more. The choice is completely on you, but this is very important part for increasing your wealth. So now let's talk about the number of companies that you should have in your portfolio. See, there is no hard and fast rule that how many companies you should have. Ideally, you should have a number which you should be able to track easily, a number in which you will be able to do buy on dips if the situation comes. So this number varies from individual to individual, plus portfolio size to portfolio size. Based on my experience, what I would suggest is for individual who have just started and whose portfolio size is till 3 lakh rupees, they should target to have 10 to 12 companies maximum in their portfolio. And out of those 10 to 12 companies, 70 to 80% of the companies should be market leaders, should be consistent compounder companies, because those companies will keep your portfolio stable and will also not give you sleepless night, which is very important when you are starting something, because whenever you are starting something, you need to give time to learn that thing. It is not a place where you can earn fast money without having knowledge. Maximum people try to do that, and that is why you have seen the results in the data as well, that maximum people who enters the stock market end up losing money. Why? Because they do not invest time in learning things. They invest time mostly in buying what people are saying without doing their own research. And 70-80% which I'm saying should be the market leader and consistent compounder. Then out of the 20-30% which is remaining, you can either choose a medium cap company or a small cap company. But when you are choosing those company, also try to find out companies which are fundamentally very good, whose profit is increasing at a very good rate, because then only they are going to support your portfolio, or they are going to provide a push or a boost to your portfolio. Okay, too much gyan. If you are still listening, kudos to you. It means that you want to learn something new. You want to learn about stock market, which is great. Next is on the quantity. So in terms of quantity, try to avoid buying quantities which is very less, like 1 share, 2 share, 3 share, because this is not going to help your portfolio. Even if that share, after buying 1 or 2, 3 quantities, even if it multiplies by 3x, 4x, it is hardly going to make any difference in your portfolio. So think about the company before you invest in it, and then invest a proper amount. Now coming on to the percentage amount. When you are building your portfolio, the maximum percentage amount that you should give to a company should be 10%. Irrespective of how good the company is, irrespective of how much you are in love with that company, it should not exceed 10% at any given point of time. So if I take a sample portfolio of, let's say, 15 companies, then in 7 companies you should invest 10%, so your 70% is gone. Then 20% you can buy mid-cap companies, and you can split it into 5% each, so you will be able to buy 4 mid-cap companies, and then you are left with 10%. And that 10%, if you want, you can split in 3 companies by 3%, or 4 companies at 2.5%. So 7 plus 4 plus 4 will be around 15 companies. And 15 company in the portfolio is a sufficient number of companies to diversify your portfolio, to reduce the risk, and also to get better and focused return. Now coming on to the companies that we need to prioritize. So in my view, you should be first prioritizing market leaders. More such, why? Because you are new to stock market. So you need shares which can keep you in the stock market, because if you want to make money, there are 2 rules. One, not to lose your capital, and these companies will help you in that. Second is you have to stay in the market to earn from the market. If in the initial stage you will start hunting for multi-baggers, small cap, micro cap companies, there is huge possibility that you will end up losing your money, and then you will be frustrated with stock market, and you will eventually leave stock market, which is going to be the biggest mistake, because stock market is a place which can change your life forever. But you have to do proper study for that. So start with market leaders, consistent compounders, and then once you gain some knowledge in the market, what are the things that you need to avoid, what are the things that you need to check, then you can explore small cap companies, mid cap companies, and then try your luck in those companies. But again, those have to be done under certain parameters and rules. You should not be investing too much amount in those companies, taking the worst case scenario in mind. Even if those small caps goes to 0, then your entire portfolio should not suffer. But trust me, the more time you will spend in stock market, the more you learn about the stock market, how to find out stock, how to check fundamentals of the stock, how to look for good business, you yourself in some couple of years will be able to find good companies. Now coming on to the final point, which is trading and investing in the same portfolio. I would personally not do it at all. First suggestion should be, if you're new, do not try trading. Start with investing first. Start with investing in good companies first. As in, when you spend more years, then you start with trading. Then you start with swing trading and different kind of trading, in case you want to do it. But if you want to do it, the ideal way would be to have 2 different portfolios. One should be your investing portfolio, where you should not do much changes. You should either do buy on dips whenever there is an opportunity, or buy share for a long term, and keep a separate trading account where you can do this trading and try your luck and do whatever you want. So, and then you'll also be able to compare which type of investing is making you more money, whether it is long-term investment or short-term trading, and you'll get the answer soon. If you have listened to the video till the end, you can mention it in the comment section or give me a thumbs up so that I know. So that's it in this video. Once again, these were all my views. Please do not follow them blindly. Do your own research, do your own study, and then take any investing decision. Thank you. We'll meet in the next video.